Your portfolio is up, your account balance is bigger than it was 3 years ago, and you're quietly falling behind. Not because of a crash, not because you picked the wrong stocks, because the assets that built wealth over the last decade were designed for a world that's already ending. 3 times in the last 100 years, this exact shift happened. Stocks kept climbing, people felt completely fine, and then they looked up 10 years later and realized the number had grown. But their actual life hadn't moved. There's a specific signal that appeared before each of those periods. It just fired again, for the first time since 2001. Once you see the signal, you can't unsee it, and you'll understand exactly why the investors who get the next decade right weren't smarter. They were just earlier. Meet Daniel. He's 38 years old, works as a project manager at a mid-sized logistics company in Ohio, and has been contributing to his 401k for 12 years. His balance just crossed $90,000. He feels responsible, he feels like he's doing the right things. And by most conventional measurements, he is. But here's something Daniel doesn't have a clean way to measure. His rent has gone up 55% since he opened that account. His grocery bill is 40% higher than it was in 2015. The cost of insuring his car, heating his house, and his daughter's school, all of it has outpaced what his portfolio is delivering in terms of what his money can actually buy. His number went up, his life didn't move. Daniel isn't a cautionary tale about bad decisions. He's an example of what happens when you measure success with the wrong instrument, when you track nominal gains without ever asking what those gains are actually worth in the world you live in. Now here's where the story gets heavier. In 2022, 2023, and 2024, the central banks of China, India, Turkey, Poland, Singapore, and dozens of other countries purchased more physical gold than at any recorded point in modern history. And they're not slowing down, not paper claims, not gold ETFs. Physical gold, held off balance sheet, outside the reach of sanctions and settlement systems. These are not speculators. These are the sovereign institutions that manage national monetary reserves. They move slowly, they move deliberately, and they move with access to information and analysis that the average investor never sees. When they buy physical gold at this pace, they aren't diversifying for the sake of it. They're hedging against something very specific: a loss of confidence in the existing monetary order. In the dollar. In US Treasuries as the default safe asset. In the rules of the financial system that have governed global trade since the end of World War II. According to the IMF, global sovereign debt grew to around $110 trillion last year. US government debt relative to GDP is now at levels not seen since World War II. The system that was built to run on debt expansion is running into the hard edge of what debt can support. The central banks are telling you something. The question is whether you're listening. This is where the signal comes in. It's not a single data point. It's not one indicator flipping red. It's a very specific pattern where gold starts beating every major financial benchmark simultaneously. The S&P 500 measured against gold, gold is winning. The Nasdaq measured against gold, gold is winning. The US dollar against gold, gold is winning. Inflation-adjusted returns, broad market indexes, consumer purchasing power, gold is winning all of them, right now, at the same time. One of those comparisons turning in gold's favor doesn't mean much. 2 or 3 is interesting. But all of them, at once, that's not a coincidence. That's the start of a regime change. There's a name for it. Capital rotation. The idea that money doesn't love one type of asset forever. It moves in cycles, sometimes lasting 5 years, sometimes lasting a full decade. And when the cycle turns, the assets that dominated the previous era get quietly replaced by a completely different set. The signal for when that turn begins? When gold starts beating everything else simultaneously. That's what's happening right now. 3 times in the last 100 years, this rotation played out. The first time was in the 1970s. The United States was dealing with relentless inflation, an oil crisis, and the collapse of the Bretton Woods gold standard, the post-war agreement that had tied the dollar to gold. When that agreement broke, confidence in the existing monetary order started to fracture. Stocks didn't crash outright. They just went essentially nowhere in real terms for a full decade. Meanwhile, gold went from roughly $35 an ounce in 1971 to over $800 by 1980. That's more than 2,000% in 9 years. Not a trade, a decade-long repricing. The people who stayed entirely in conventional financial assets didn't lose money on paper. They just spent an entire decade watching their account numbers creep upward while their actual purchasing power eroded underneath them. Then it happened again in the early 2000s. After the dot-com collapse, gold climbed from around $250 an ounce in 2001 to over $1,900 by 2011. More than a decade. Commodities broadly dominated. Hard assets won. The broader stock market went through a period that many investors still call a lost decade. Prices eventually recovered, but real returns were punishing for anyone who wasn't positioned correctly. And before both of those, there was the early 1930s. The market collapsed, the monetary system was destabilized, gold was revalued upward under Roosevelt, and the US stock market didn't reclaim its 1929 high until 1954. Not a bad stretch. A 25-year generational misallocation for anyone who stayed anchored to the wrong era. 3 periods, 3 rotations, each one lasting between 5 and 25 years. Each one preceded by the same signal. That signal just appeared again. This is where it gets uncomfortable for a lot of people. A significant number of investors bought Bitcoin specifically because it was supposed to be immune to all of this. Finite, global, outside any single government's control. Digital gold for a world that was losing faith in paper promises. The thesis was clean. If the monetary order cracks, the hardest assets win. And Bitcoin, being capped at 21 million coins, was supposed to be the hardest asset of all. But right now, Bitcoin is losing ground relative to gold. The ratio between them has been declining. And the reason matters for anyone who bought it as a hedge. Bitcoin has been absorbed into the financial system it was designed to avoid. It sits inside ETFs. It's used as collateral for loans. There are leveraged products built on top of it, mining operations financed against it, derivatives stacked around it. In the short term, that means it doesn't primarily trade on scarcity. It trades on sentiment, leverage, and liquidity, the same forces that drive the Nasdaq. For Daniel, who put $12,000 into Bitcoin 2 years ago as his hedge against the system, that insurance may not actually protect him against the risk he thought he was insuring. In a market sell-off, Bitcoin doesn't behave like a neutral asset. It behaves like the highest volatility asset in the room. The hedge he thought he had may not be the hedge he actually has. So, what do you do with all of this? The investors who navigated the 1970s rotation and the early 2000s rotation weren't smarter than everyone else. They didn't call the exact top or the precise bottom. They just updated their mental model earlier. They stopped asking, "Is my number going up?" and started asking, "Is my purchasing power going up?" Those are not the same question. And during a rotation, the answer to the first can be yes, while the answer to the second is quietly, steadily no. What they did was simple. They shifted a meaningful portion of their portfolio toward assets that held purchasing power when currencies weakened and debt outpaced the real economy. They didn't abandon everything else. They didn't sell in panic. They rebalanced, with intention, before the rotation was on the front page of every financial publication. Because by the time the rotation is obvious, prices had already adjusted. That was true in 1971 when Nixon closed the gold window. It was true in 2001 when the dot-com era ended and commodities began their decade-long run. And if the signal is reading correctly right now, it will be true again. Dollar cost averaging into assets that have historically led during capital rotations isn't a complicated move. It doesn't require you to predict the future. It requires you to take a documented, repeating signal seriously while most people are still measuring their success in nominal terms and feeling fine. Daniel is going to check his account balance this weekend. The number will probably still be going up. And if no one explains to him what that number is actually worth, in groceries, in rent, in real purchasing power, in the world as it's actually changing, he'll spend another decade doing everything right and ending up exactly where he started. The signal is there. The pattern is documented. The people who profit from the next decade won't be the ones who saw it coming after the fact. They'll be the ones who saw it coming now. If this changed how you think about where you should deploy your capital, hit subscribe. We publish fresh content several times a week to help you protect and grow your wealth. And none of this is personal financial advice. This is education so you can build your own plan. Next, Watch, is the US planning a $37 trillion crypto debt reset? It's on the screen. In the description, you'll find some useful links. 10% off Seeking Alpha products, including Alpha Picks, which has crushed the S&P since 2022. A link to my free Wealth Builders Blueprint, a comprehensive list of tools, courses, platforms, and other resources. Most of the resources are completely free, some have free trials, and some are paid. And a link to Zacks Confidential, a stock recommendation service with dual money-back guarantees. Check them out. Thanks for watching. See you on the next one.